Today is March 11th, 2026, and this is the 10 Mil Club. What we're going to do, this is a penny stock spotlight, and there is a Facebook page that I get on way too much called Penny Stock Millionaire. In fact, I don't really scroll Facebook a whole lot anymore. I have Penny Stock Millionaire and a couple of other trading and investing Facebook pages bookmarked, and I spend way too much time on Penny Stock Millionaire. Penny Stock Millionaire, if the world of investing was a street with a bunch of restaurants on it, and at one end of that street, you had really expensive restaurants that were like $250 for a meal, and that meal was fantastic. And then a little further down the street, you had 100 restaurants with $100 meals, and they were really, really good. And then you had chain restaurants past those that had a good serviceable meal and they were $50. And all the way down to the other end of the street where you had greasy spoon restaurants that would give gastrointestinally questionable meals that were $8 to $12. If all of those were a stock that you could buy, or at least an area of the investing world, Penny Stock Millionaire would be the rain-soaked alley all the way at the end of that street behind the greasy spoon restaurants, where I occasionally in a suit and tie step into the back because I can't help it and look at all of these drug and liquor addled people laying on the wet asphalt, leaned up against a green dumpster going, "Hey man, you need to try some of this. It's real good." And that would be what Penny Stock Millionaire is as far as the world of investing. But I can't help it. I go back there and look because I'm absolutely certain that somewhere among all of this junk laying around has to be something that's more valuable than it looks. So Penny Stock Millionaire is just this. Let me show you. So there is somebody on Penny Stock Millionaire named Creative Ostrich 4066. Every single day, and I mean every single day, I think Saturdays and Sundays included, Creative Ostrich 4066 posts something about this short about FUBO. It's always trying to encourage you to buy FUBO. Creative Ostrich 4066, whoever you are, you have my absolute admiration, because that level of dedication and tenacity and persistence, I mean, that's just to be admired. It's really something. In fact, it's to the point where if I go through a business day and I don't see a post by Creative Ostrich 4066 on Penny Stock Millionaire about FUBO, I get a little bit worried because I'm not sure the person's okay. I mean, that person's become such a part of my life. So Creative Ostrich 4066, you were absolutely awesome. I've posted a few things to Creative Ostrich 4066 about FUBO. I get barely an answer back. And I'm sure it's because, you're really somebody in the FUBO world, and I'm just Mark the Shark. So I understand that, but really, I mean, you have my utmost admiration. The other day, I did post something on one of Creative Ostrich 4066's posts, and I got an answer back from someone named Matt Taylor. And usually, if anybody answers me back, I write a lot of long form stuff, which is very out of place on Facebook. If I write something, usually, I mean, I get plenty of reactions and a few thumbs up and stuff, but rarely do I get anything to really think about. Matt Taylor has given me something to think about on FUBO. My reaction to FUBO, especially with the unmitigated but baseless zeal of Creative Ostrich 4066, is FUBO just has not seemed like the thing to buy for me. And so Matt Taylor gave me some things to think about, and so I want to go through these things and some other things that I found and really kind of share them with you. And understand, nothing on here is investment advice. It's all entertainment, and I am not an expert in the field, not at all. So if you buy this stuff, you buy it at your own risk. I take no responsibility for what you do, but it is interesting. So let's discuss it. All right. Matt Taylor's first comment: when we look at the number of shares that exist, we see that Hulu, Vanguard, BlackRock, and the executive directive officers hold more than 92% of the shares that exist. It looks like Vanguard might actually own more currently than the document shown in the photo. The document show. This document right here is actually a document in February. FUBO announced that they were going to have a reverse stock split. So tell you what, let me start there and work up to the reverse stock split, and we'll get to that point. I put this together. It is not sexy. It's and I apologize. I have not figured out how to not put myself down in the corner here. I will probably figure that out eventually. So FUBO is a streaming company, and they IPO'd in 2020. There are a lot of notes there. Just know that what they did was, in order to capitalize the company, they issued $350 million worth of convertible bonds. All of those details aren't all that important, but they 3.25% and 17 roughly shares per $1,000 bond. By 2023, the end of 2023, they had to do something, and they got in touch with Mudrick Capital Management, which is obviously one of their main investors, and they got them to take $177.4 million of 2029 convertible notes in exchange for $205.8 million of their 2026 convertible notes. But that's the only favorable part about it, was that they only have to pay back $177.4 million as opposed to $205.8 million, because the new notes, instead of having a 3.25% interest rate, have a 7.5% interest rate, and they're convertible into a little over 260 shares per $1,000 bond. So much more dilutive, more punitive to the company, but they don't have to pay back quite so much money. I don't know what the backroom deals were that made that happen, but I can tell you that the fortunes of the company changed significantly between the IPO in 2020 and 2023. We'll get to that in just a second. In 2025, the watershed moment comes around, and Disney agrees with the company to reverse merge. Basically, what they did was Disney said, we're going to take all of Hulu plus live TV, which was part of a Disney division. It was part of the Hulu division, not Hulu itself, but part of the Hulu division. And they reverse merged FUBO into this new company that included all of previous FUBO and Hulu plus live TV. Disney got 70% of the equity of the company, and it's important to know that they actually got all of the Class B shares. So even now, there are two classes of shares that are out there. You can't buy both. You can only buy the A shares because they're the only ones that trade. But the Class B shares were all given to Disney, 100% of them. They represented about 70% of all of the equity, and Disney can't sell them for 2 years from the time that they were issued back in October 2025, which wasn't really all that long ago. And Disney gave a $145 million note to help capitalize the company at 4.2% maturing in 2031, which is not a bad deal. It makes sense because Disney is, if you think about this, Disney was doing one of two things. They were, and this is important for where we're going, Disney was either they were taking a part of their company that they knew was damaged and almost certain to fail and putting it with FUBO and sending it off to die, or they were merging it with FUBO and figured that if they controlled the situation and gave it decent leadership, that over time they might be able to turn Hulu plus live TV along with FUBO at a bigger scale into something that was profitable. Actions speak louder than words. And so my thinking is that if Disney gave a $145 million note and started helping them figure out how to recapitalize the company from that point forward and put leadership that Disney chose, because Disney controls that company. It's a controlled company. If Disney did all that, I don't believe it's option one. I think Disney wants that to survive and thinks it can survive. Otherwise, you wouldn't, because you wouldn't put $145 million into something that you were just sending off to die. So apparently, from within, they're trying to make it work. That's just what the actions speak to me. On January 14th, 2026, the company used some of that $145 million, most of it, in fact, to buy back most of the remainder of the 2026 notes. So there's about $4 million worth of them still outstanding, but most of them are gone. And that means that the 17 shares per $1,000 bond, most of it really didn't go out and dilute the shares. Probably some of it, a bit of it, but not nearly as much as could have. And then on February 3rd, 2026, a reverse stock split was announced. We don't know at this point whether or not that's going to be a 1-for-8, a 1-for-12, or somewhere in the middle. They announced that it's going to be somewhere between those 2 points, somewhere between 1-for-8 and 1-for-12. And they sent what I'm kind of in my head refer to as the non-proxy. The SEC requires them to put out proxy materials, but in them they actually say this isn't a proxy because Disney controls the company and you have no vote. So, but important point is that the Class A shares that are out there trading have no vote, and those are the only ones you can buy. Disney actually can convert those B shares into A shares, but the A shares will have no vote if they do that. So why would they do that? They can't sell them for 2 years, but that's the way it works from the inside. So the first point here from Matt Taylor, when we look at the number of shares that exist, we see that over 92% of the shares are held by large investors and executive directors, officers, blah, blah, blah. Okay. Here is the interesting thing about that. Okay. This comes out of, it's a combination of that non-proxy that they sent out, because that's just February, like last month, as of this speaking. And the number of shares is a little bit different than it was in the last 10Q, which is as of the end of last year, as of December of 2025. So from what we know, Disney owns about 947 million shares, which are all Class B and can be converted to Class A. The Class A are the tradable shares. Total is about 1.3 billion shares. If you look, the document that Matt is referring to is this document right here. It's a little bit tough to see. The important point is that the way their accountant has the document set up, it says that Hulu LLC has 72.9%, BlackRock has 7.8%, the Vanguard Group has 6.2%. Add all those up, and you get Matt's 92%. That is not too far off the truth, but it isn't quite exactly the way it is. The way it is, Hulu, which Hulu LLC is the Disney entity that controls this, is 72.9% of all of the equity. And it's 100% of all the B shares, but 72.9% of the equity. This over here is really what's important. BlackRock owns 2.1% of all of the equity. The Vanguard Group owns 1.7% of all the equity. You can't just add these up. So when you add it up, you actually get 72.9% plus 2.1 plus 1.7, and that's 76.7%, not the 92% that could be seen right here. That's still Still a lot of ownership, 72. Do be advised that Disney has the ability to sell that at some point in the future. But here's kind of the way that shakes out. If you know the next, right? So next bit from Matt. When we look at the short interest, about 50 million shares are shorted, and only about 50 million shares remain open to retail investors. I don't know where you go for short information. I go to FinViz because it's free and you can get a paying account, but on their free account, if you simply go to any stock and you click on short float, you can see how much the last reporting of the short float was. Now, important to know, short float information is as much as 15 days or about a half a month in arrears. There are websites out there and information sources that claim to give you better short information. They're actually extrapolating based on what they can find, but it's not official short information. So the last stuff we have is from February 27th. And yeah, it's about 16% of the float, which is higher. It had been climbing from through the year, about 10%, then 12, then 15, got all the way up to, got down to about 13 and 13 and a half, then 16%. So, and that's about 55.6 million shares that are short, about 16% of the float. Matt later says that it doesn't seem like that would cause a short squeeze. I think you're right on that. I don't think that's a high enough sale for a short squeeze. Previously, some directors, executives sold their shares between $4 and $6. I don't see these groups taking profit unless we reach that level. Again, I don't know about you, but I go to secform4.com to see recent buys and sells. And if I'm going to buy something that's a deep value, I like to see insiders buying it. This happened to me with Sunoco Products Company late last year and early this year. SON is that we got down in that dip, and the next thing I saw, once it looked like we had a demand zone. If you study day trading at all, once we got a demand zone and the stock did kind of a double bottom, it looked like the insiders, especially the leadership of the company, just started buying shares. We don't have that here. We have the chief executive officer being given shares. Here he is awarded some shares, David Gandler, and they just sell them. They keep some, but most of them they just sell them. Nobody in the company is going out there and buying shares. There would be green here and buying. So SEC Form 4, I'm not seeing any buying. So I think you're right on that, Matt. I don't think that they would be, they sold them here at $3 and $2.50. The stock right now is about $1.73. I'll get Thinkorswim pulled up here and we can take a look at it. But we just don't have people buying, shares down here. Give me just a second. I actually thought that I had Thinkorswim up. So David then says the company has plenty of cash to continue operations, over 400 million, and they were only down 26 million this last quarter, and that should be saving them money due to the new partnership and not having as much in legal expenses. They have a positive EBITDA in the last quarter. And so it might be time for people to load the boat. A short squeeze on this company would be ridiculous. That's where he says it doesn't look like we would have a short squeeze. Yeah, so here's FUBO. This is kind of what I want to. So FUBO IPOs at $10 a share. This is back in 2020. Now that's a different era of time. Okay. That's the depth of the pandemic. The we're we're all going to be at home forever. Nobody's going out again. Streaming is going to be just in high demand, and you can see that totally pick up in the stock. It tops out here between $50 and $60 a share for a few brief moments. Gets pretty solidly for a week or so over $40 a share. And then from then on, the fortunes of the company just really aren't great. And a lot of that is because the company really has never made a profit. It just, I don't know. It's just one of those that the term zombie company kind of comes to mind. They IPO'd in an era when everybody thought that one thing was going to happen. And then as the pandemic lets off, we end up, completely coming off that particular sentiment. This right here, that jump is where the announcement is made. That's early 2025, where Disney is going to reverse split and put FUBO into a company, and the stock vacillates for about a year. I'm going to pull up a year. Vacillates for about a year. We get late into the year last year, and then this probably was triggered by late year tax loss selling, and it just kept going. Stock just simply started selling off from about November on. It just sold off. And the premise behind the penny stock millionaire folks, because this stock gets talked about a lot, of course, is that it's low. It should be high again. I get that. I myself am interested in low price stuff that could be high priced again. Got to be careful with that, because the question is there any value in it? Now, by trade, I am a real estate appraiser and a business valuer. And I have appraised many businesses, and I've appraised an awful lot of real estate and even some intangible personal property. I did not run a valuation on this company. I can do that. Maybe I'll do it in a part 2 and come back with that probably next week, because I have a lot of work to do between now and then, because I do have a day job. But we would need to figure out how much value there really was in this. But you can just see the sell-off, and then you can just see this kind of bottom out here. And the most recent earnings, which, by the way, were the first earnings we had of the combined company. So we only have 1 quarter of combined FUBO and Hulu Plus Live to go on. Let me show you what I have on that. So I built a kind of a fundamental screen. This is my fundamental screen for FUBO, and you can look at this. It doesn't mean a whole lot, because in truth, you have two ways that it's presented. I use an extension called Wise Sheets in order to pull this aggregated data into this sheet that my wife and I created. Props to her for helping me create it. But you can kind of see here, this quarter right here with the $1.5 billion of revenue is very different than any of these quarters before it. They're all 370 million or something like that. The reason is because the way Wise Sheets data is presenting this is, before this quarter, they're showing only FUBO, not the combination of FUBO and Hulu Plus Live. So everything back here is not of any use. Now, the interesting thing is, if you look over the 9 quarters previous, their operating income ratio was actually improving. I mean, it had gone from a -26, -16, blah, 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 all the way up to -5. This last quarter, with the new scale, it's now at -1. So it has been kind of improving. And there was some improvement through here too in the gross profit ratio, where they rise from a 6, a 7, all the way up to a 16, 17, and 20. And then there's a combination. My guess is there's going to have to be some restructuring that goes on for them to get profitable. But with Disney's runway now, they probably will be able to do that. They never cover their interest. You can see their interest coverage ratio is always from the beginning negative. It does improve to a certain point, but then it's really, really bad again. And this is not a so it wasn't profitable for, it was improving some. It's not profitable now. If you use Seeking Alpha's numbers, you can see the 1,544,000,000. For some reason, they calculated a little bit differently. With them, I think they're actually showing the previous, they're showing it under like a combination method as if it was combined and just, so there's a little more. But the interesting thing, you go down there and their EBITDA says that they've got like a negative 3.6 number. I don't even know what it means. And one of Matt's claims is that the EBITDA is positive. On my quick screen, it actually does show a positive EBITDA right there. So what I had to do, go back to my notes here that I put together. I dug into the most recent 10Q. I'm not going to pull that up here because it's almost drudgery to read. If you would like to read it, you go pull it up. It's great. But EBITDA, earnings before interest, taxes, depreciation, and amortization. There's the E. That's their quarterly earnings of a loss of $19 billion. Add back the interest that they had there. There are extra zeros on this. Add back the interest. This is adding back their tax allowance. Do that or don't. That's up to you. Depreciation and amortization, add that back. That's a fake expense, and it's the largest one. And you do end up with a positive EBITDA of almost $7 million. I am not, for some reason, I never can seem to add up EBITDA. It's a non-GAAP measure. And look, my MBA's concentration was in accounting. I worked for PricewaterhouseCoopers for 1 year before I went back into appraising real estate. I have a bit of accounting background, but for some reason, I never can get EBITDA to add up correctly, or EBITDA, as a lot of people call it. Anyway, I never can get EBITDA to add up correctly, but we've got Y sheets telling us that it's positive. We have my calculation, as I can find it from the 10Q, is positive. So they do have positive EBITDA. Here's the thing about having positive EBITDA. If your EBITDA goes negative, that is earnings before interest, taxes, depreciation, and amortization. In other words, you have to, so depreciation and amortization are fake expense, and they're quite often the biggest expense you add back. They're book expenses. They aren't real cash going out. But interest and taxes will be once everything's all settled. If you don't have positive EBITDA, you don't have enough money that your company's making to pay interest and taxes. Now, if you're taking a loss, the thinking is you're not paying any taxes, but you have to cover your interest. And if you don't have the money to cover the interest, you're in a lot of trouble. You end up very quickly in a death spiral, and you may be a walking dead company for a while. But if you don't have the money generated through operations to pay interest, you're in a lot of trouble. And it looks like from this one quarter that FUBO has positive EBITDA. So that's a good thing. So you're right about that, Matt. Matt's statement here, though, is that company has plenty of cash to continue operations, over $400 million, and they were only down $26 million in the last quarter. Not sure where you're getting the down $26 million, but I pulled these numbers out of their 10Q as well. Again, feel free to check me on them and go get them. They have about $452 million worth of cash. At least they did at the end of 2025, and that's the most recent quarter that we have. They have these other things, marketable securities, receivables, blah, blah, blah. The important thing on this first one is current assets and current liabilities. There's a ratio called the current ratio. If you take current assets and divide current liabilities into it, you get this ratio right here, which if you divide these two numbers, you get 0.845. There's the math of how you do it. Feel free to pause the video and take a look at that yourself. That is a good ratio if it's between 1.5 to 2. Below 1 is not great. That's not really great liquidity. The idea is that you don't have enough current assets to actually pay the current liabilities if you had to pay them off all right now. Cash ratio is just the cash and marketable securities divided by the current liabilities. That is okay if it's between 0.5 and 1, with greater than 1 being good. The cash ratio, because there are no marketable securities, is also 0.845. So from a cash ratio standpoint of just being able to take the cash and marketable securities, stuff that you could sell right now, and pay off your current liabilities, we're in better shape. We're okay because we're between 0.5 and 1. The quick ratio, which is the cash, marketable securities, and the receivables, of which there are a lot, and a huge one is this related party receivable right there. I didn't get into the weeds on what that is. It's it probably is something from Disney is my guess. I don't know, but it's a lot of money, and I could figure it out. But that makes the quick ratio a bit more sketchy because the receivables from a related party. However, if Disney's intent is, of course, to make FUBO go, then we're not too terribly worried about the related party receivable. I don't know. We'd have to look it up, but that makes the quick ratio 0.804, goods above 1. It's not too terribly far off that. It's not horribly bad. I would say the cash ratio is really what supports Matt's claim. And, you know, Matt, we're not off that far. So 0.845, you got a point. They do have cash, right? It's not great. The cash situation of the company is not great. It's not like I'm gonna look at this and I'm gonna go, hey, that's wonderful. Let me have that right now. But, you know, that's what we have. So here is where I'm going with this. FUBO, just all right. All of that's fundamentals. Let's go to a technical standpoint. I may do a part 2 to this, where we actually pop this. I have a valuation sheet. I may pop it into my value sheet and try to figure out if one thing you do need to know that those bonds before Disney came along, that they pushed off Mudrick Capital Management, that they pushed off, and instead of having $205 million worth, they had 177, I think it is, $1 million. Those are highly dilutive. Over 200 shares per bond that they can be converted into. If they don't buy those back, the math I did on that is it's about 40, I wrote it down, but it's like 46 million shares extra that it could dilute the shares, and that's a lot. If I do a part 2, if you comment and say you want to see it, I'll figure all that up, and I'll figure out, you know, kind of what kind of value the shares might actually have in the same back of the napkin format. But here's the deal. We have downward share price momentum. All I can come up with is that Creative Ostrich 4066 is probably what Bill O'Neill and Mark Minervini after him would refer to as an involuntary investor. My guess is I commiserate with you. I used to be this person all the way up to a year ago. I was this person. I don't do this anymore. Ever since I learned how to use stops and risk control and have a little bit of discipline. I don't have as much discipline as I wish I did. You probably bought a ton of shares at a much higher price than $1.17 a share, and are an involuntary investor now. So you got to shill the stock every day, hoping that somebody is going to come along and go, hey, that's really, really great. This is not shorted enough to short squeeze. I think Matt's right on that. There are a lot of shares out there, though. It's something like 100, almost 200 million shares tradable sitting out there. If we don't know that the 51 million shares that are shorted aren't all in institutional investors, they could be. If they are, then there really are 199 million shares sitting out there with another potential 46 million of dilution if they don't come across with the money on the bonds by 2029 to Mudrick. So there's a reason this stock is all the way down. Now, it's really easy to bag on a stock when it's down. It's really easy to sit here and go, let me tell you why that stock stinks when it's down. Everybody kicks you when you're down. But I wouldn't buy this today, and I almost certainly wouldn't buy it this week. Earnings came and went, and it was a gap down sort of thing, and off it goes, and it's just really flat. Something's going to happen. There's going to have to be some kind of large announcement, which I don't see coming. There's going to have to be a set of earnings where maybe they now cover the interest as well as having better positive EBITDA, much bigger number. Something's going to have to happen to entice the market to see this stock and turn around. Until then, what we have, let me grab my finger here and pull this over. We're looking at about, April, I don't know if I go straight across, April 2nd, 3rd, first week of April, before the share price bumps this downtrend line, and the market then has to make a decision. With no earnings sitting right on top of us and no other announcement, unless there's just an unforeseen one, I don't know is coming, the share price is going to have to decide if it's going across that line or if it's going on down. And I don't know where a stock's going. Anybody who tells you they know where a stock's going is just, is trying to sell snake oil. But I would not buy this until I saw the market turn this around. Now, the human temptation is to go, well, I can buy a ton of it at $1.17. On a bad day, I can buy a ton of it at $1.12 or $1.13. Yeah, you sure can. But you have to remember that the most valuable resource you have isn't actually money. It's actually time. You are only given so much time in this life, and the first 10 years of your life, most of which you don't even remember. And the last 10 of your life, you really aren't even taking care of yourself most of the time. So really, if the average age of the American male is something like 83 and a half years, you really only have about 65 years. And every day that goes by is extremely valuable. Believe it or not, more valuable than the money you make, though the money is a close second. So if you put your money in this at $1.17 a share, and then you have to sit there and wait, and possibly it's going to hit that line and go down, that's not a good investment. It's not even a good trade. So I cannot recommend buying this right now. Now, positive EBITDA, Disney behind it. We got some good things. So let's keep an eye on it, but don't go buying it right now. I would not go loading up the truck at $1.17. Instead, I'd be finding other things to put my money in. And that's kind of the way I see it right now. If you leave me some comments and you're interested, I will go and do evaluation on the stock. I'll pull up some comparables and run evaluation, and we'll kind of look at it. All of which, of course, is very imperfect. I'll have to find competitors, and there will be a ton of conjecture about whether or not the competitors are useful or not. And that will be entirely up to you to decide whether you believe anything I say. But I'll either need to think about it next week, or I'll need to have somebody ask for it. So thanks a lot for listening. That was kind of a deep dive I did, and I thought I'd share that with all of you who wanted to hear it. So FUBO. My recommendation, don't go buying that this week. There are, and don't go buy, probably not this month, but I do enjoy the penny stock world. Man, I really do. And we'll do several of these segments. Probably a lot of them will be 3 or 4 of them that we can just quickly scan and go, yeah, don't do this. But FUBO actually had something to it. So right off the bat, something to talk about. Just I would not buy it right now. Thanks a lot. We will talk to y'all later.